Greetings from the Prague Stock Exchange. The real estate developer, CTP, has reported its quarterly results, and since the Czech Republic is one of the most important markets for the group, we invited Martin Otte, the head of investor relations at CTP, to tell us more about them. Hello, Martin.
Hi, good afternoon. Thank you for having me.
Looking into your results release, what drove the 15% increase in your net rental income to over 360 million euros in the first half of 2025?
So if you look to the growth of our net rental income, it's driven by two main aspects. One is the deliveries, because each year we delivered, of course, new buildings. And if you look to our portfolio, it's roughly 10% larger than it was in H1 of last year, due to the new deliveries that come online. So that is the main bulk of the 15% growth of net rental income you are referring to. The other part is driven basically by the like-for-like growth. So the growth in rents on the standing portfolio. Because we also have been able to increase on the standing portfolio the rents with around 5%, which is driven by indexation. The contracts are on a yearly basis indexed, and there are some different rules. Some are fixed escalations, others are CPI. But as well, of course, when the contract comes up for expiry, we are renegotiating the lease and setting the rent at market level. So the indexations together with those expiries drove the 4.9% like-for-like growth. So if you take the 10% portfolio growth and you take the like-for-like growth, you basically come to the 15% growth in net rental income.
Thank you. If we look at the new business, the year-over-year growth of signed leases that reached almost 600,000 square meters in Q2, like the overall year-over-year growth slowed down to 3% from 24% in the first quarter. What is the cause of this dynamic?
If you look to our leasing activity, it always is a bit more volatile because it depends in which quarter you sign the big lease. So on average, I think indeed, if you look to the H1 leasing, we are up 11% year on year. So 11% more leases signed compared to H1 last year. We also continue to do so at higher rents, 5% higher rents in H1 of this year compared to H1 24, which both are basically the illustration of the continued demand we see from our tenants. Because if they take more space and then higher rents, that's a good sign of the underlying demand drivers. There are always one-offs, which drives to be one quarter higher than the other. Depending whether we sign a lease in March or whether we sign it in April. We are not so much looking at it on a quarter-by-quarter basis, because if you zoom in too much, you are always a bit lost in the noise. So we look at the longer-term trends. Where do we see the rental income grow? Where do we see the demand grow? Also, if we look going forward, we have more heads of term signs. So how it typically works is that we first do heads of terms, which is a higher over commercial agreement. And then we are working on the lease agreement. It can then be 3 or 4 or 5 months later. So if we look this year, we actually have more heads of term signed than last year. So that also gives us our confidence for the leasing ability in the second half of the year. So the demand overall remains strong. And yes, there will be quarters which are up and quarters which are down. But it's the long-term trend which shows the underlying drivers basically of demand, which are fundamentally long-term drivers, and that comes back to the nearshoring activity that we are seeing. And yes, if you sign one factory, you don't sign it in the next quarter. It comes back to the healthy economic growth in the Central and Eastern European region. It comes back to the professionalization of supply chains, which are demand drivers which remain intact. And we foresee also to remain intact over the coming years.
Perfect. Thank you. There is a chart in your results presentation with the development of head of terms, so we can refer the viewers to that as well. Looking at the average monthly rent signed, that increased by 5% to almost 6 euros per square meter in the first half of the year. What drove this increase, especially in Germany and Poland, where it was the strongest?
So if you look to Germany, we leased this year some of our newer developments. So you might remember Germany, we entered through the acquisition of Deutsche Industrie REIT in 22, which is an older portfolio and slightly smaller buildings. On the back of that, we also started to buy new land bank opportunities, which are mostly brownfield sites. So we bought a big plot in Düsseldorf, in Mulheim, in Krefeld, in Aachen, etc. This year, we saw the first leases coming in for those brownfield redevelopments, which are then leased at market levels. And if you look to market rent in Germany, it depends a bit on the region where you're looking at, but it typically ranges somewhere between €6 and €12. There's a huge difference whether you look at the Düsseldorf area or North Rhine-Westphalia and München, that are more expensive areas. If you look to the north of Germany, it's a bit cheaper. But this year for us, those new developments came into the leasing mix, while last year the leasing was more on the older Deutsche Industrie REIT portfolio. So that's why you see the increase in rents in Germany. Also in the Deutsche Industrie REIT portfolio, we are increasing the rents materially compared to what it is in place, but we don't cut to the levels of the new developments. Poland is driven by a change in market conditions. That was also the reason why we entered actually Poland in 22. Poland was often a market, especially if you compared it to Czech, it was relatively cheap, but it was a market dominated by traded developers. So people would develop and afterwards sell. They were not so much interested in the long-term rental growth potential because they don't own it anyway. So they were more interested in flipping the asset after completion. But with the interest rate increase that we have seen in 22, you basically saw that model to become under pressure. It was for us the opportunity to basically enter the Polish market because we saw the supply coming down. And if the supply of new buildings is coming down, the rents will go up. And that was our thesis actually for entering the Polish market in 22. And that's what we see now reflected, that we continue to see rental growth in Poland. It's still cheaper compared to what it is here in Czech, for example. But we see good underlying growth, which is helpful for the business. In Poland, we have a lot of new developments. We have now, in the 3 years that we are active, we have built up a standing portfolio of around 800,000 square meters, but also another 300,000-400,000 square meters under construction. So we are bullish on the outlook of the Polish growth for our business.
What influenced the 38% increase of net valuation result of investment property?
So if you look this year, we saw for the first time a yield comparison coming through in the standing portfolio. Because if you break down the revaluation results, there are two elements. The revaluation results on the projects under development and the revaluation results of the standing portfolio. The projects under development is quite a recurring revaluation coming through as the projects are progressing in terms of construction as well as leasing. And we'll have each quarter a certain amount of revaluation on our pipeline as we are completing those projects. Next to that, we have the revaluation of the standing portfolio, which is driven by two elements. One is the rental growth and two is the yields. So last year, we had basically stable yields. This year, as the interest rates are coming down, we saw some yield compression, which drove to a larger amount of revaluation of the standing portfolio, which you saw reflected in the P&L of this year.
Thank you. Looking at the bottom line, you reported adjusted EPRA earnings per share of €0.42 for the first half of the year. What should help you achieve your confirmed guidance of €0.86 to €0.88 for the whole year?
It's the deliveries coming in. Also, if you look historically, most of our deliveries are taking place in the second half of the year. So with those deliveries coming online and the rental growth related to those, we foresee, and that's also why we confirmed our target to reach the 86 to 88 cents per share.
Okay, thank you. You already talked about Germany, and that's an interesting market because, for example, the Financial Times journalist Wolfgang Münchau has recently released a book about the German economy called Kaputt, the end of German business wonder. Whereas in summer, the CTP released a report on Germany titled Europe's 21st Century Powerhouse. What does the CTP see in Germany that others may not? Why is this market interesting to you?
I think what the German economy has proven, or the Germany as a country has proven, is the ability to reinvent itself. Has the German economy challenges? Yes, clearly. Many of the European economies have. Germany as a country is one of the only countries who have still, if you look to Western European markets, if you compare to France, if you compare to UK, who has the ability to invest. If you look to Germany's debt to GDP, it's at a much more sustainable level than any of the other Western European markets, which gives Germany the capacity to invest and innovate. And Germany has proven, if you look to the history, to be able to do so. Yes, there will be transformation, and some of the sectors in Germany will, energy intensive, labor intensive sectors will disappear. But new sectors will emerge, and whether that's related to clean tech, whether that's related to defense, with also the new, of course, German defense package being announced, or whether that's related to more semiconductor. We see the new semiconductor basically region evolve around Dresden. And that's ultimately also what Germany has been good in, innovation. We are building, for example, the new factory for Quanta, the Taiwanese chip manufacturer. It will be the first production location in Germany. Ultimately, and we toured with them across several European countries. In the end, they ended up in Germany because for them, they have such a margin. They are much more focused on where are my end clients. One of their big clients is ASML, which is just across the Dutch-German border. And we see opportunities for those businesses to land in Germany. Will all businesses in Germany survive? No, but that's the natural evolution that an economy goes through when it matures. And that is the opportunity we see in Germany. That's also why, if you look to our portfolio, we have been active more in the brownfield sites. So the older industrial plants, which are typically very well located, because they were built in the 50s and the 60s at the edge of the city, have become inner city locations. But the industry has disappeared there. So we bought old steel plants from Vallourec, for example, which moved their business to Brazil. Clearly, given the cost of labor, cost of energy, Germany is not a country to manufacture steel. The same with a lot of the suppliers in the car industry. It's basically too repetitive and too simple work to do in Germany, given the labor costs that there are. But if you look to the German education and the German research ability, it has the ability to reinvent themselves. And that is the opportunity we see in Germany. Germany is the third largest economy in the world, after the US and after China. It's the third largest economy, ahead of Japan, ahead of India, etc. Will it grow 5% per year? No, but it is at such a high level. Even if it grows 1 or 2%, there are immense opportunities for us as a property developer to play a role.
Thank you for sharing this perspective on the German market. Looking into Asia, you have been the Czech National Expo partner at Osaka. A few years back, you have opened the CTP Asia office. Your founder, Raymond Voss, has visited Taiwan. Last time with Richard Wilkinson, we've talked about nearshoring in Europe. And now you are exploring market options in Vietnam. What brings you to this market?
Yeah, so it comes back to our clients. Because if you look to CTP and historically our market expansions, they have been client-led. The client asking us, can you also do something for us in country X? Or can you also do something for us in country Y? If you look to our current client mix, we have seen a material increase in clients from Asia. The last 1-2 years, basically 20% of our leasing came from Asian clients who are producing in Europe for Europe. Why do they do that? They basically diversify their supply chain and produce more locally. And that's the nearshoring trend that we talked about. But it's not only produced in Europe for Europe, it's also produced in, say, Mexico or Texas for North America. it's also diversified away from China. So often they have a China plus one strategy in Asia. And then if you look to manufacturing locations, Vietnam scores very high in Asia. Relatively open economy, politically stable, still cheap labor and energy cost, which are key ingredients basically for manufacturers. That's why we have been starting looking at Vietnam, because we see the potential there in terms of the development of the country. 100 million people, still very fast growing in terms of GDP. Many of our clients, both European as well as Asian, being active there in the production. And also, if you look to our portfolio mix, which is maybe a bit different than other industrial and logistics players, roughly 50% of our tenants is actually from the industrial side. So we see the natural fit for us also in Vietnam to be a first start for us in Asia to start developing from our operations there, and also serve our clients in Vietnam, but maybe in the future also other Asian countries.
If we look at the Czech Republic, you are the market leader of the Czech Republic. You have many assets here, and you also have many assets in Brno, where you are currently building the first two-story industrial hall in the Czech Republic in the city park Brno-Líšeň. Are we going to see more of these double-deckers in the future?
I think so, especially with the scarcity of land and the value of land. We are looking to basically optimize the usage of the land availability, which comes back to double story. In Europe, you see a few of those. We have one also as well in Amsterdam, in the harbor. But if you go to many Asian cities, it's quite normal. If you go to Japan, you see many of the double story one. Same in South Korea, same in China. If you go to Singapore or Hong Kong, typical logistics buildings can be 5-6 layers. Wow. So yeah, with the land availability, zoned land availability, I of course speak to the land which is available for industrial use. I would expect to see more double-story buildings over time, especially in inner city locations. Look, if you are developing a bit out of town, it doesn't make sense because land is still cheaper there. But if you are really into the inner city locations, more focused on the last mile, double-story will be a way going forward.
Thank you. That it's actually taking place at the former Zetor complex in Brno. So that's like you said, it's in the urban area. Thank you for your time. I'd like to invite our viewers to follow your quarterly results. The Q3 results will be released on 6th of November. I think you explained very well the reasons why Germany is an important market for you. And I would like to also invite our viewers to listen to our previous interview with the CFO of CTP, Richard Wilkinson, as he explained more about the interesting business model of CTP. Thank you for your time, Martin.
All right. Thank you.